Welcome to The Explainer. This is where we dive deep into big ideas, and we do it by going straight to the source. So let's get right into it. There's this question that's probably been bugging you because it's on everyone's mind right now. Is your money silently losing its power? We're talking about inflation, of course, and what it really means for your investments. And to figure this out, we're not just going to guess. We're going straight to the master himself, the father of value investing, Benjamin Graham. All right, so before we can talk about a cure, we have to understand the disease, right? Let's start with inflation itself, the silent thief.
So what is inflation, really? Well, to put it simply, it just means that every single dollar you have buys a little bit less today than it did yesterday. It's like this slow, silent erosion of your wealth, especially if your money is just sitting there not working for you.
Okay, so we know inflation is the bad guy. What's the common cure then? What's the advice that you hear everywhere for beating this silent thief? You've probably heard this a million times, right? The conventional wisdom is to just own stocks. The thinking goes, hey, as the cost of living goes up, the prices and dividends of the companies you own should rise right along with it. It feels logical. It feels like a really natural hedge against inflation. And this idea got so popular, it became almost like gospel. You had people in positions of authority, like the Maryland state treasurer back in '99, saying it makes zero sense to have any money in a bond fund. The message was loud and clear: go 100% stocks. It was framed as the only smart move. But, and this is a big but, Benjamin Graham, in his legendary book, The Intelligent Investor, basically tells us to hold on a second. He says before we just jump on that bandwagon, we need to do a little historical reality check. So let's ask the big question. Does history actually show this clear, direct link between rising inflation and rising stock prices? Is it really that simple? Well, Graham did the hard work and compiled the numbers, so let's take a look at what he found.
Okay, so here's the data Graham lays out for us. Now, if the common wisdom is true, we should see a nice, neat pattern, right? When consumer prices go up, stock prices should go up too. And yeah, sometimes it works out that way. Look at that period from 1946 to 1950. Inflation up about 23%, stocks up 21%. Pretty close. But then look at 1915 to 1920. Consumer prices went through the roof, up almost 100%, but the stock market actually lost money. And again, in the late 60s, you see pretty hefty inflation, but stock returns were just blah. Graham's point here is crystal clear. This guaranteed link just isn't there in the historical data.
This all brings us to one of my favorite quotes, one that Graham loved. When J.P. Morgan was asked what the stock market will do, he simply said, they will fluctuate. That's it. It's a powerful reminder that there are no guarantees, and the history we just saw proves there is definitely no close, reliable connection between inflation and how the stock market performs. So this leads to a really interesting puzzle, right? If rising prices don't automatically pump up stock values, then why not? What's going on behind the scenes? See, Graham argues that it's not so simple. Inflation doesn't just raise the prices a company can charge, it also raises a company's costs. Think about it. Wages go up, raw materials cost more, the whole shebang. And on top of that, just to stand still, just to maintain their operations in this more expensive world, businesses need a whole lot more cash. So these two forces are like heavy anchors, preventing profits from just floating up with prices. And this chart, wow, this really shows the hidden culprit in action. Take a look at the period from 1950 to 1969. You see that profits before tax more than doubled. That sounds great, right? But look at the other bar. Corporate debt grew by nearly 5 times in that same period. That is a staggering increase in borrowing. And what does all that debt mean? Well, it means higher interest costs. That's the real drag on profits. So the key takeaway here is that a huge chunk of any potential gain from inflation got completely wiped out by just paying the interest on all that new debt. Whatever they gained in higher prices, they basically gave right back to the bank. Okay, so if stocks aren't the silver bullet we thought they were, what about other stuff? Tangible things. What about gold? What about real estate? Are things any better? Well, Graham looked into these too, and his conclusion is that they're no simple fix either. Take gold. For a 35-year stretch he analyzed, it was actually a terrible investment. It didn't even keep up with inflation, and it paid you zero income along the way. And real estate? Sure, it's a possibility, but as you know, it can have wild price swings. It's full of potential pitfalls, and for the average person, it's really, really hard to diversify properly. So, we've shot down the all stocks idea, and we've seen the issues with things like gold and real estate. So what's left? This is where we get to the core of Graham's timeless advice. Let's look at the intelligent investor's actual strategy. What Graham warns against are the two extremes. On one side, you have an all-bond portfolio. What's the risk there? Well, it's the very thing we've been talking about, inflation just silently eating away the value of your money. On the other extreme, you have an all-stock portfolio. And the risk there? It's the wild emotional roller coaster of the market, those crushing declines and thrilling advances that can mess with your head and your wallet.
And this all leads to Graham's prudent policy. It's not about predicting the future, it's about preparing for it. It all starts with accepting one simple fact. The future is uncertain. You just don't know what's coming. So you guard against the unexpected by maintaining a balance of both stocks and bonds. And here's the key mindset shift. You carry stocks not as a guaranteed inflation beater, but as a form of insurance against it. It's a hedge, not a certainty.
And that really leaves us with the most important question of all, the core of Graham's wisdom. Is your portfolio prepared to fluctuate? See, the ultimate goal isn't to build a portfolio that can perfectly predict the future, because that's impossible. The goal is to build a portfolio that can survive the future, no matter what it throws at you. It's not about being right, it's about being resilient.